Good evening, welcome to tonight's webinar member only content where we look at ASX investment opportunities in review. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Investor Signals provides a broking account service which includes our model portfolios across both ASX and US equities. We also can operate an independent portfolio where we work in partnership with you to execute ideas we jointly agree on and utilise derivatives to enhance portfolio returns. In particular, call options to add yield to defensive names, but also using calls and puts for directional trading. The technology we're using tonight is the Investor Signals member area, and if you're joining us for the first time, the service under your 30-day trial can be renewed for $1,320 for the year. If you'd like more tuition on how to navigate your way around the technology, please call me on 1300 614 002. The graph up on screen there is the Nasdaq. We've been using this as our main barometer and tracking sort of the extent of the optimism, if you like, in the equity markets. We're starting to see a slight breakdown in this momentum, and the Nasdaq's now trading below the 10-day average, and I've highlighted the resistance there as 13,510. If we take a closer look at the Nasdaq graph itself, we can zoom in, which I'm loading that up, and we'll have a closer look at that action towards the end of last week that started to create a bit more volatility in equity markets. So what we saw with the Nasdaq is a couple of days of selling, roughly down about 3% from the highs. So what I've done is shifted from a resistance level down to those prior highs of sort of Thursday, Friday last week, which gives us a level of 13,500 on the index. As I mentioned, it's closed below the 10-day average, so we continue to watch this closely, and that's the beginning of a setup where you want to start thinking about having a slightly more defensive positioning in your portfolio. If we have a look at the individual stocks within the ASX 100 and identify the names that we want to be focused on in this environment, so we get the percentage gains to the top. We organise them in buy signals, so we're going to start by going through the best performing stocks under buy signals today. We'll get a certain way through the list and we'll switch from buys to sells, and I'll just highlight or draw your attention to when that shift occurs. So starting with the first stock, we've been fairly bullish on TPG and on Telstra as risk adverse opportunities in a market that if we do switch to a risk off phase, we'd expect these assets to perform well. We're already seeing TPG up from the $7 support level, now trading $7.40, $7.50. It reports in early February. We're looking for further clarity out of the company on what the combined business looks like following the Vodafone acquisition. Ideally, we'd like to see a target up at around sort of $8 to $8.50 before we take profit there on TPG. Domino's has been under buy conditions there since 72. So again, if you're joining us for the first time, what I'm referring to is the most present signal on the graph is the green box at the bottom, which means it's under primary algorithm buy signals. The red and green arrows, think about those as shorter term momentum or shorter term indicators. Domino's continues to deliver good performance or earnings growth, especially with their expansion in Japan. CSL I've been commenting on about the blog, so if we have a look at this, we're getting algorithm buy conditions. We've got the shorter term momentum indicator pointing higher there in the green arrow, and we've got a close above the 10-day average at around 270. Even from a fundamental standpoint, the stock appears to offer good value at around that 270 level and comfortable using that as a point to accumulate the stock. IDP we're not active in at the moment, but it is under algorithm buy conditions from lower levels back at around $13. It's a recent entry into the ASX 100. Fortescue, we've seen iron ore prices soften a little. I'd expect to see Fortescue find support above this prior high here, so somewhere above $19. We'd be looking for this to find support, so I'll just shuffle that up there, and somewhere between maybe 19.50 and where we are there at around $21, I'd expect that to find support. Keep an eye on the stochastic, watch for the short-term indicator to trend higher, back up through that slower stochastic as a shorter term trading opportunity. Lendlease, we like the long term fundamentals, but we think this could be a tough earnings result for the market to digest, and we'll review those numbers closely as they come through over the coming weeks. Gold's a good opportunity at the moment. It's consolidated really for the last 3 months. If we continue to see that risk off mood that we looked at there in the Nasdaq play out over this part of US earnings, and this week's a particularly heavy week. I think a little over 100 S&P 500 companies report earnings this week. Gold should do well. So buying Newcrest, Gold Roads, Saracen, Northern Star, all make sense. Newcrest delivered good production numbers. Their costs were a little higher than the market anticipated, but we've seen a correction from around $40 down to $25. Think that offers value down here at the moment. Aristocrats in the model portfolio, support here at around $28, trading above the moving average, and there is a place for that in portfolios, albeit at a lower sort of percentage allocation. There's still some risks there and a lack of clarity around what new machine demand looks like given the disruptions to the global casino business. Evolution Mining we see this bouncing off support here at around $4.50, trading above the moving average. Sol, not doing anything there, just highlight that we have had the recent shift to algorithm buy signals. Mirvac Group, the way we've approached this property basket at the moment, so you might be aware that you've seen buy signals across Stocklands, GPT, Mirvac, Goodman Group. Our preference has been to focus on Goodman Group and then to buy a basket approach to the property stocks through an ETF, and I'll update you on the blog in the next day or two on our exposure there through the ETF market, rather than focusing on adding too many of the single property stock names for obvious reasons. But Mirvac now under buy conditions. Link Administration, support here at around 450, trading a little bit higher. Could be a small bit of upside left in that, but obviously the acquirer has walked away from that transaction at the moment. Cochlear, support there and under algorithm buy signals. It's rallied off 180, now trading 200. We hold that in model portfolios. Stocklands, we hold a small amount of this, but again our preference has been to sort of stick more with the broader based ETF. Stocklands under algorithm buy conditions there from around $4, now pushing $4.50. Goodman Group, expensive but high quality business, 9 to 10% earnings growth, which is well above average for most real estate investment trusts, and that's obviously due to its exposure into the faster growing e-commerce fulfillment centre area of the real estate market. And you're seeing GPT, Stocklands and others trying to reposition their portfolios for similar exposure. But Goodman Group should find support in a low interest rate environment down here at around that $17 a move higher. Xero, we've been waiting for this to shift to buy conditions, so support here at 125. Think about adding a small amount of that into portfolios. AusNet really hasn't done too much, but it is under buy conditions, support that around that 170 level. Wesfarmers continue to like this. It is getting a little expensive and they do need to deliver good results, but I think the commentary from the market from Wesfarmers should continue to support some upside momentum there. So Wesfarmers remains a fairly overweight position in our portfolios, as does Sonic Healthcare. The earnings outlook here looks solid, high single digit earnings growth. Support there at around that $33 level, should be able to hold that and trade higher with a reasonable dividend yield, so that deserves to be in portfolios. Northern Stars and Saracen, both buy on the dip, as is Newcrest, so comfortable with adding gold at the moment. Cleanaway's corrected from 270 down to 220, back into a buy zone. I highlighted that on the blog today. A2 Milk, obviously very volatile. We've seen two earnings downgrades. Yet to see sort of enough evidence that the 45% odd correction in the share price is enough to factor in the bad news, and we'd like to see some indication from the company that they're seeing a stabilisation and a return to growth. But I do sense that we're getting down to levels here in A2 Milk which will represent good long-term value for patient investors. Charter Hall, another example of a real estate investment trust that's recently shifted to algorithm buy signals. Saracen own that. The merger with Northern Star, you're obviously going to see cost synergy benefits from the two companies coming together, but I think there's room in portfolios to own Saracen, Northern Star, Newcrest, and possibly even Gold Roads. Afterpay, bit difficult to buy into this at the moment. It was back under algorithm buy signals at lower levels. Looks a little expensive. We'd like to see that correct further before adding that into portfolios. Kiwi Insurance, I've just popped support there at around $8. Obviously they had a slightly disappointing earnings update. Qantas, hard to get visibility on earnings, but just reminding you that it's now under algorithm buy signals there with support possibly at around that 450 level. Aurora, after 2 years of earnings downgrade, we've now seen a stabilisation in the share price and what could be the beginning of a higher low formation. So I've shuffled support up there at $2.40. We've got the recent algorithm buy signals, and we've started adding very small amounts of that into portfolios at the moment. Downer EDI under algorithm buy conditions. So this comes back onto the radar, but CIMIC has been our preferred exposure up until now. Next DC, not doing it there, but it is under buy conditions. And both of the recent signals have picked up good higher low entry levels, but do have some concerns around the fundamental reporting of their financial data. BlueScope, a terrific earnings result here, surprised the market to the upside. It's probably still a buy on the dip, and I've created a fairly wide range there, just being mindful of the backdrop of volatility in those US indices, but somewhere between that sort of 1450 to where we're trading at the moment should be a support level, and BlueScope should be able to hold that and trade higher. Ramsay Healthcare, not really a growth opportunity. We wouldn't expect too much on the upside here with Ramsay, but it's a defensive yield. We continue to like exposure to the healthcare space, owning it, looking for a move back up to around $70 and either taking profit or selling covered calls. Sydney Airport's a little like Qantas, hard to get visibility on short-term earnings trends over the next 6 to 12 months, but we have had a correction from 750 back down to 570, so continue to watch that one a little bit closer. Transurban, we like this. We've added this into portfolios. It is dependent on obviously business returning back to normal, traffic volumes returning back to normal, not only in Australia but in America as well. The dividends being cut to reflect the slightly lower cash flows, and we continue to monitor any announcements out of the company there, but around $13 Transurban seems like a reasonable risk reward proposition for portfolios. WiseTech rallied off that algorithm buy signal there at $27, created a new high, pulled back, even buying there today, but not a stock that we do too much in. Coles, we continue to like this, close to fully valued, but delivering high single-digit earnings growth, obviously fully franked dividend yield. So there's a place in portfolios there, own it, sell covered calls, drive the extra income. Amcor's had a correction from around 1650 down to 1430, thinking that this is pretty close to support where it is at the moment, so buying the stock and or buying call options as a way of leveraging the upside breakout there. We're looking, I think Amcor reports actually in the US maybe the middle of this week, so we'll start to see a bit further detail on what those earnings results look like, and I'll update you on the blog. Beach Energy, the correction that I've been calling for in these energy names are just suggesting that they were a little bit overdone and ready for a buy on the dip we're starting to see that pattern emerge at the moment, and beach back at around that 150 to 160 should be a reasonable entry level. Car sales, we like this business, but acknowledge that it is trading on a high PE, but around $19 should be support. Cube Holdings, December port volumes were up around 7% on the same time last year. The stock is relatively expensive, so we're of the view that it mainly bumps sideways over the next 6 or 12 months, but on a 2 to 3 year outlook, the fundamentals look supportive there for Cube as a long-term position in portfolios. Star Entertainment, these casino businesses, hard to see visibility around earnings trends at the moment, but interesting that that's now switched back to buy signals. Computershare bumping sideways after 2 earnings downgrades. The market will be looking for more clarity out of Computershare that the earnings trajectory is returning to one of growth. APA Group, we like this because we think it's a fairly safe harbour even if volatility picked up in equity markets. So buy this on the dip. There's justification for holding that in portfolios. GPT, one of the REITs that have been recently switched under buy conditions, but again, maybe rather than adding too many individual REITs to your portfolio, think about a small allocation into a ETF that picks up a broad base basket of them, and maybe if you're looking to go overweight a REIT, think about Goodman Group. LTM, not doing there at the moment, but is under buy conditions. REA Group, expensive. We'll review the upcoming earnings. Illumina corrected from the $2 resistance level, now back under algorithm buy signals there at around 160, looking for that support to hold. Appen Group, after the 30% earnings downgrade, the stock price has been hit hard, and we're continuing just to watch this. For traders looking for a breakout, just be patient, look for that to trade above that 10-day moving average, and then you can maybe get a bounce to the upside. Fisher & Paykel we like. It is expensive. Probably Ansell is slightly better value than Fisher & Paykel, but Fisher & Paykel are delivering above average earnings growth, and it should support the high PE for a little longer. Track sideways within this sort of $30 support to 33, 34 resistance, but continue to like the fundamentals there for supporting that. ASX struggling to find a base here. The spike in trading volumes during the March to July period is going to likely be hard to be repeated. But we are getting down to levels where the 100% fully franked dividend yield that's attractive there at nearing 3%, we're going to start seeing buyers step into this ahead of the upcoming dividend. So just keep that one on your watch list. JB Hi-Fi, not there at the moment. ResMed delivered a good earnings result. I've shuffled support up there at around $26. I think there's argument that that belongs in portfolios. We certainly hold it in models. Now what we've done is switched into stocks that are under algorithm sell signals. So we'll focus on the ones that have the current sell signals. Incitec Pivot was a counter trend trade. We continue to see strong earnings upgrades there for Incitec, and we'll watch that when it next shifts to algorithm buy conditions. Ansell we like from a fundamental standpoint. I don't think there's any urgency to take profit on this trade, but maybe back up at around 42, filling that gap at $41 could be a level that you think about locking in the gains. Boral resistance up at around $5. Tabcorp, interested to take a closer look at the upcoming earnings, but at this stage thinking resistance at around that $4. Origin, strong revenue growth from the LNG side of the business. Retail electricity continues to be a struggle, but it could be a counter trend trade to think about. Watch for it to trade back above the 10-day average. I think the downside risks are fairly low there in Origin. Oz Minerals, we're looking for a deeper correction here. We'd like to see this back at around $15 and a switch to buy signals before we add that in. Nine Entertainment up against resistance there. Bendigo Bank. So if we think about what's happened, so roughly 2 weeks ago, the US banks led earnings season with JP Morgan, Wells Fargo, Goldman's, etc., all reporting their earnings results. On average, we've seen a correction in the US banks somewhere in the order of 5 to 10% following those earnings results, and that's followed through to maybe not quite as much weakness in the Aussie banks. But today, given the volatility in Wall Street, Thursday, Friday, the Aussie banks opened up pretty soft today, but there was some reasonable buying interest and drove them higher. But still a little concerned that they run into resistance below that prior high. Reece not there at present. Bank of Queensland, likewise a little cautious that it's unable to break through and make new highs, so we'll watch that closely over the coming days. Same with ANZ. So all these banking stocks, I'll continue to review these, and it's really a catalyst that just depends on the level of risk sentiment in the US equity market as to whether the Aussie banks can trade higher. If that Nasdaq remains below that 10-day average, you'd expect to see these Aussie banks run into resistance below that prior high. BHP, comfortable with that, likewise with Rio, but acknowledging that they're unlikely to continue to move higher if the S&P and the Nasdaq struggle below that 10-day average. Telstra we like. We think the confirmation of the 14-cent dividend staying in place, the upcoming split where they're going to spin off Infrastructure Co. Helps to underpin downside risks, and Telstra there at around $3 to $3.30 was the trade. NAB back up against resistance. We'll keep an eye on how these US equity markets trade before we sort of take too strong a view on the banks. Medibank resistance at around 310, so not doing AMP at the moment. Orica, reasonable opportunity for this as a counter trend trade, so we're sticking with Orica at the moment. Rio Tinto, don't think the downside risks are too great at the moment, but again having to monitor sort of how the US equity market trades. But for the moment, iron ore prices remain fairly buoyant, and it's feeding through to strong dividend flow into an outlook for BHP and Rio. AZJ may be getting down to a level where it finds some yield support, but there's not much in the way of earnings growth there to support the story. Mineral Resources, it's corrected from $41 down to $34. It's not yet under algorithm buy signals. We may see a little bit further downside before we see that switch into buy conditions. Santos, not too far away from switching to buy conditions, maybe a little further, maybe possibly a retest of around that $6 level, and we'd expect to see that added back into portfolios. Macquarie, it's interesting if you compare the performance of Goldman Sachs to Macquarie. Goldman's really been strong over the last 3 or 4 months, whereas Macquarie's bumped up against this resistance. It's had the sell-off similar with the other banks, had a weak open and then there was buying interest in it, but we continue to sort of base that around those US indices. And I'll finish tonight's recording just with a recap of the S&P 500 and the Nasdaq. Ampol, $30 resistance, $25 support, should track sideways within that range. Woolworths, we continue to like this as a safe harbour, owning Woolworths, owning Coles, selling covered calls over it to create extra income. High single-digit earnings growth, again safe harbour if volatility picks up. Westpac, as with all the banks, a bit concerned that they run into resistance below the prior high. Woodside Petroleum's created a new high, so on this sell-off we'd look for an algorithm buy signal in the coming weeks, and we'd see that added back into portfolios. Coca-Cola up against resistance unless we see a higher bid from the European Coca-Cola division. Insurance Australia Group bumping sideways here, could be a surprise for 2021 as a recovery opportunity, so keep a close eye on this. Probably going through what looks to be a basing sort of pattern around this $4.50 to $5 level, and we'll keep an eye on sort of further evidence of an uptrend starting to emerge in the coming months there on Insurance Australia Group. AGL, finding it difficult to see new buying support here. If we look back, we've got the algorithm sell signals here that have picked up the peak in those rallies, and until such time as it traded above the moving average, hard to sort of see any evidence there of buying pressure coming into AGL. Brambles, despite it being under algorithm sell conditions, think this sort of 10.50 level should hold as reasonable support. Sell $11 covered calls and create the extra income there. ALS not doing, they're up against resistance at around that $10 level. Crown up against resistance at around that $10. Again, hard to get clarity on what the earnings picture looks like. Oil Search, so again, part of this energy complex where we're seeing this correction, and we'll soon see a shift to algorithm buy signals in the likes of Santos, Oil Search, and Woodside Petroleum. So we continue to monitor that sort of buy on the dip opportunity there. Suncorp not doing, they're a bit cautious with the banking exposure. James Hardie up against resistance at around that $40 level. Seek, expect this to move low. I think that's a little expensive up where it is at the moment. Just to jump back to Seek, so the downside risk here in Seek as we see a further correction is probably not until we saw a deeper sell-off back down around $24 or $25 that we'd see that shift to algorithm buy signals. Challenger rolling over under resistance there at around $7, not doing anything there. Magellan has really struggled after running into that resistance at about $65, continues to move lower. We got the short-term sort of indicator there as a first precursor to saying that we may be starting to see a little bit of buying interest build, but if you're looking for a counter trend trade, you'd want to see that above that 10-day moving average. Vicinity under sell conditions, Dexus under sell, Reliance under sell, Centre Group under sell conditions, Spark Infrastructure under sell conditions, Treasury Wines remains under sell conditions, Atlas under sell. Worley's disappointed the market today. This is a stock that's under algorithm sell signals, and we've seen an earnings downgrade. Obviously not doing there at the moment, and there we are back to TPG. So to really try to summarize what we're focused on at the moment is looking for areas of the market within infrastructure, telecommunication, healthcare, and areas of fairly defensive earnings streams, so consumer staples and some technology growth opportunities, whether it be sort of through an indirect exposure to e-commerce through something like Goodman Group as examples, where we're trying to sort of not be exposed to the really high stretched PE multiples of 50 or 80, 100 times earnings, and in particular when we look at the US market, we see those levels as some great concern. If we come back and just look at that macro picture that's driving our thinking around equities at the moment, we're just mindful that the Nasdaq has traded below the 10-day average. We're coming into a heavy period of earnings where we're going to see earnings results from some of the large technology companies, large US industrial companies. When we look at what's happened to earnings results so far, even though Apple delivered a terrific earnings result, the share price traded lower. Even though the US banks delivered good earnings results, they've traded lower. So there's evidence in the market that even delivering good news, and even news that's ahead of market expectations, is still resulting in profit taking. So that's enough for us to be a little bit concerned about the backdrop for equity markets. If we look at the S&P 500, we can see that it too has moved below the average. Now we've seen this a few times, so there's no certainty that this is the beginning of a more concerning downtrend, but obviously it is the start of the pattern that you need to be cautious around. So when we think about the S&P, I've flagged resistance there at 3,850. If the market was to trade back through that, we're probably back in an environment where optimism is driving further participation in these high PE names, but we also could be at the cusp of a rotation out of high PE names into defensive value, and for that reason I think portfolios need to be tilted slightly towards that, and that's certainly our focus. So if you'd like to know more about our portfolio allocations and have a chat with me about our broking account service,